Hello explorers, thanks for joining us again and welcome back to our channel. If you are joining us for the first time, we appreciate your time. In this episode, I will be diving into the reason why secondary sanctions may imperil the United States of America's financial leadership. I will be looking at why the Americans' unprecedented secondary sanctions are a high-stake gamble that could reshape global trade and spell the end of United States of America's financial dominance. In this episode, I will be diving into three very important research. First, why the United States of America's secondary sanctions on global banks are unprecedented. The second thing I will look at, why emerging markets are largely complying while seeking alternative. More importantly, I will close this episode as the reason why many nations seek non-United States of America's dollar trade and payment system. I have enough to cover in this video. To support our channel, to encourage our detailed research, we encourage you to continue to smash the like button and share the video to appreciate our work. So without any more delay, let's just dive straight into it. The United States of America's effort to contain Russia through sanctions may have unintended consequences. The most recent round of pressure and targets third parties doing business with entities that support Russia, namely banks worldwide, and it is in countries in emerging markets that may be the most affected. Washington's restrictions may inadvertently push nations into uncharted territory, potentially threatening the global dominance of the United States of America's dollar and its financial system. But first, let me look at US sanction explained in details so you have a better picture. Why politicians in Washington decide on introducing new sanctions? It is the United States of America's Treasury Office of Foreign Asset Control, abbreviated as OFAC. You will hear me use this as I go down to the conversation. That is the principal authority issuing and regulations and regulating actually both primary and secondary sanctions. Primary sanctions are economic restrictions by which Washington can target individuals, businesses, and also foreign governments through asset freezes and confiscation, travel bans against foreign persons, and trade embargoes of countries for acts which threatens the United States of America's national security or breaches international law based on their own perspective. All individuals and entities connected to the United States legal jurisdictions through citizenship, incorporation, or residence must comply with those sanctions. Additionally, transactions processed anywhere in the world through American financial institutions or in the United States of America's dollar, thereby forming a financial link to Washington jurisdiction, are also required to comply with primary sanctions. If you look at strategic option, transactions processed anywhere in the world through American financial institution or in the US dollars are required to comply with primary sanctions, like I pointed out. Currently, some of the foreign governments subject to the OFAC, which I pointed abbreviation as the Office of Foreign Asset Controls. Primary sanctions include countries like Russia, Belarus, North Korea, Iran, Cuba, Syria, Venezuela, as well as other mostly countries in the African continent and also in Asia. OFAC is also increasingly targeting business entities and individuals in China, Hong Kong, Turkey, and the United Arab Emirates and Pakistan in a lengthy list focused on mainly developing countries. If you look at strategic option, secondary sanctions on the other hand is in contrast has been created to deter non-US persons, those not having any economic or legal links with the United States of America jurisdiction, from conducting business with foreign governments, individuals and business subjects to primary sanction. The secondary sanctions imposes penalties on non-United States of America persons by disallowing them to engage with American commercial interests, including access to the United States of America's financial institutions or use of the dollar. Unlike primary sanction, which are enforced by seizures or situated or in the United States of America's dollar-dominated assets. Secondary sanction depends on the need by the U.S. persons to access the global largeness of the American financial system and universality of the dollar. But first, allow me look at the unprecedented secondary sanctions here. First, previously, the United States of America's secondary sanctions were comparatively selective in scope. However, on December 22nd, 2023, if you draw back, the Treasury imposed a new set of restrictions targeting all non-United States of America's financial institutions accused of dealing with Russia's military-industrial base, a definition which was also considerably broadened in view of those new sanctions. Foreign financial institutions now risk being penalized for conducting or facilitating Russia-related transactions even when there is no economic or legal connections to the United States of America. These activities may include facilitating significant transactions or providing any service to organizations or individuals connected with Russia's military-industrial sector. A secondary sanction imposed penalties on non-U.S. persons by disallowing them to engage with American commercial interests. So you have that in mind. Going back most recently on the 12th of June 2024, the Office of Foreign Asset Control further expanded the definition of Russian military-industrial base to reflect the Kremlin's increasing use of Russia's entire economy to support its battle operations. The definition now incorporates numerous individuals and entities linked broadly to Russia's procurement networks and supply chains, including all persons who are subjects to the United States of America primary sanction. But first, let's dive into the developing economies, the growth ties with Russia, how this play with regards to these current operations based from the United States perspective. Contrary to expectations in Washington, several months after the imposition of secondary sanctions, the global majority's trade with Russia has continued on an upward trajectory based on figures, especially for larger developing economies. In relation to Russia's export energy economy, which are key to funding its weapons industries. Recently, weekly trade data gathered by the Center for Research on Energy and also Clean Air shows a steady rise in fossil fuel export from Russia to China, India, Turkey, and Brazil. The diversity of Russia's mix of energy export to each country is also increasing. This is interesting. Although major financial institutions in those developing economies are known to have taken steps to rigorously comply with the United States of America's new sanction measures to preserve their access to global market, a plethora of new non-financial channels are smaller scale banking organizations in emerging countries. These mushrooming groups of entities is facilitating transactions between Russia and major developing economies to avoid sanctions. This burgeoning industry of new intermediaries is a reflection of increased discontent among governments in key developing countries at their own being subjected to the vastly expanded extraterritoriality of the United States of America sanction. Countries have responded to Washington's secondary measures in various ways. Let me look at those individual countries to give you a perspective here. First, China. In the immediate aftermath of the introduction of the secondary sanctions, China's trade with Russia declined sharply. Yet, in the second half of this year, bilateral trade has begun to recover. Moscow's trade with Beijing is likely to further improve as new avenues facilitating cross-border business transactions are speedily brought outstream. To point out, after China's larger bank halted acceptance of the yuan payment from Russian enterprises in April of 2024 this year, a growing number of Russian businesses in May began setting up direct payment accepting agreement with smaller Chinese financial institutions. In the same month, Russian President Vladimir Putin and Chinese President Xi Jinping met to resolve payment issues arising from secondary sanctions. They reportedly agreed for specially authorized banks to be set up, a Sino-Russian border region, so to point out, allowing Russian importers to also open non-resident accounts with those institutions. This is an important development. Chinese non-financial entities are also opening offices in Russia to accept payments in rubles. Many long-term development plans to Russia and Central Asian nations overlap in areas where the ruble is widely accepted as a means of exchange. Chinese companies have also been utilizing cryptocurrencies in their transactions with Russian partners. Such transactions are typically routed through Hong Kong. If you look at strategic options here, the Central Bank of China and Russia plan to establish longer-term diversity in foreign currency trade between themselves and partner economies in the developing world. Also, this includes the prospective introduction of a multi-currency trading mechanism referred to as BRICS Bridge. The novel concept will enable intra-BRICS trade to be settled in a variety of the 10 BRICS plus member countries and also currency. If you are new to this channel, we'll encourage you to smash the like button and share the video. Let's move to the second country here, looking at India. As one of the world's fastest growing economies and its largest democracy, alongside being the largely English-speaking Asian nation governed by the rule of law, India, perhaps more than China, set an example of much of the developing world in terms of aligning against the United States of America's secondary sanctions. In a recent move, the Reserve Bank of India has permitted commercial banks from 22 mainly developing countries, including Russia, to open special accounts for settling payments in Indian rupees, a process which strengthens India's bilateral economic ties with the participating countries and reduces dependency on the United States of America's dollar. New Delhi has a long-standing track record of seeking innovative ways of getting around United States of America's secondary sanctions. These include Washington's restriction measures, or Iran, to which India responded by instituting a rupee real arrangement, allowing it to continue making payments for Iran's crude oil supplies in local currency. The scheme laid the groundwork for a similar national currency accord launched between New Delhi and Moscow after the United States of America's first imposed sanctions on Russia in 2022. If you look at other strategic options with regards to India, Indian officials are also looking at ways of avoiding the long arm of the American sanctions by setting up distinct businesses dealing exclusively with the Russian market. As it's reported, the case in China, this will involve Indian businesses establishing separate production and facilities to serve the Russian market. If you look at issues with regards to balancing India's trade books with Russia while gardening also around the United States of American secondary sanction was a principal reason for Indian Prime Minister Narendra Modi's intensive talks with Mr. Putin in Moscow in July of this year. The leaders agreed on a plan for their mutual strategic cooperation to 2030 and forecasted bilateral trade reaching over $100 billion by this year. If you look at other aspects, considering the country of Turkey, Turkish President Recep Tayyip Erdogan is unlikely to be dissuaded from his non-aligned status following recent United States of America secondary sanctions. Not only has he refused to participate in the Western sanctions regime, but Ankara trade relations with Moscow skyrocketed after Russia's invasion of Ukraine, expanding by over 55% since before the conflict began, to the point out. However, the new United States of America secondary sanctions have hit Turkish-Russian bilateral trade hard. Further sanctions introduced in June 2024 were imposed on a record 13 Turkish companies trading in machine tools, industrial polyester, and also chemical internal combustion engine, pumps, and electronic products. Most recently, The United States of America has even warned NATO ally Turkey of serious consequences if it does not halt the export of military-linked goods to Russia. This toughening U.S. position may be an outcome of the talks on July 3rd to 4th at the Shanghai Cooperation Organization meeting, where President Putin and Erdogan also agreed to expand their annual bilateral trade over the coming 5 years to over $100 billion annually from the current $445 billion for the point out. Let's take a look at BRICS here to have a better picture. The 10 nations BRICS group has been generally critical of the United States of America sanctions due in part to members' growing economic ties with Russia. Brazil President Luiz Inácio Lula da Silva has been especially vocal in denouncing the secondary sanction in addition to his long-standing opposition to the United States of America sanctions against Venezuela and Cuba. He has also called on developing countries to work towards replacing the dollar with their own currencies in international trade. If you look at the strategic options here, since the outset of the Ukraine war, Brazil has substantially expanded its import of oil products and also other commodities from Russia. This includes being a significant buyer of Russian fertilizer. Russia accounts for a quarter of the country's total fertilizer imports. Brazil has criticized sanctions against Russia, which through United States of America secondary sanctions could make shipping companies refuse to transport some goods to Brazil. South Africa, on the other hand, South Africa's President Cyril Ramaphosa has also opposed the United States of America's sanction on Russia, asserting that bystander countries were suffering on account of the measures. In light of his stance, according to Mr. Ramaphosa, various analysts have also warned that South Africa could face American secondary sanctions, including the risk of excluding from the SWIFT also system. After raising concern over Pretoria's ties to Moscow, the United States of America's Treasury Secretary Janet Yellen warned South African officials about consequences of violating Washington's sanctions. While Saudi Arabia, on the other hand, a country currently joining BRICS, has steered clear of criticizing the United States of American secondary sanction, it is willing to diversify currencies used in selling its oil, align it with other major developing countries seeking alternative to the United States of America's dollar and to minimize risks from expanding the U.S. secondary sanction. The extent to which Saudi Arabia continues to employ the petrodollar moving forward could be a pivotal indicator of further financial ties between major developing economies and the United States of America. As I close down this episode, let me paint a scenario based on my own perspective here. The less likely developing economies confront to secondary sanctions here. First, since the United States of America secondary sanctions were first announced in December of 2023 and further bolstered in 2024 June, governments in developing economies and their financial institutions have been quick to comply with restrictions. In many instances, the larger developing economy banks and also financial institutions acted fast to cut their links, both directly and indirectly, with the Russian military industry sector. On balance, the global largeness of the United States of America's financial industry and flexibility of the dollar as the primary reserve currency, combined with the open and also significant size of the US market to absorbing international trade, means that developing economies have very few equivalent alternatives for enabling their economic prosperity. So to point out, moreover, while some political leaders of developing countries may hit the news or also headlines with their own denunciation and criticisms of the dollar, in practice, there is very little concrete actions among them in agreeing on suitable substitute to the American currency at the moment. The question of alternative to the United States of America dominated financial system is equally as challenging, as large proportion, if not a majority of banks and large financial concerns in the developing economies remain in state ownership, subject to governance and also government agencies as much as market forces. They are simply not as open or flexible as the United States of American-based financial institutions in the financing of trade, investment, various cross-border banking activities involving foreign businesses. Despite the various new developing economies initiatives which has been crafted in response to the recent controversial United States of America secondary sanction. Most may only be temporary forms of relief rather than permanent features. Some initiatives are essentially so peripheral as to have no more than a marginal difference in global trade and finance. Lastly, some of the major proposed alternatives to the dollar and the SWIFT system, and that have been much taunted as a threat to the United States of America's dominance, such as the BRICS bridge, seem to be more of an fulfillment promise than awakening reality. However, let me look at the likely scenario here. Developing economies move to alternative financial and trading arrangement. The aggressiveness of expansion of the United States of America secondary sanctions over the last year targeting non-US financial institutions across the world has been unprecedented in scope and scale. As the greater power rivalry intensifies between the United States of America and Russia, China, and Iran, among other competing states, the likelihood of Washington resorting to additional secondary sanctions by leveraging its leadership in sectors such as technology, aerospace, high-end manufacturing, and beyond will intensify, so to point out. However, in response to what appears to be evolving into a normalized set of unilateral extraterritorial policy tools to also wage against its rivals, the developing world is being galvanized into seeking alternative financial, trade, and economic measures to protect their independence and sovereignty. It is also becoming increasingly clear that the developing world, which has borne the brunt of the United States of American secondary sanctions for some years, is undertaking tentative steps towards building parallel trade and also investment platforms to act as viable future substitute to the current United States of America dominated international economic and also financial architecture. While Russia is clearly the most combative in seeking to dislodge the United States of America from its prime position, it is the role of much larger economies, including China and India, involved in both their individual and also collective efforts that will be key in defining whatever new institutions and financial and trading order materializes. While the expansion of the US secondary sanctions was meant to break the back of the Russian economy through dissuading financial organizations in third countries from dealing with Russia, it may ironically have the contrast effect, prospectively engendering the demise of America's global trade and also financial dominance. Hopefully we've informed you with regards to the current strategic issue. If you consider the United States of America's dominance perspective with regards to the secondary sanction, that's the reason why a number of countries in the continent of Africa are engaging other strategic partners and making strategic decisions. Hopefully the United States of America will come to terms to the basic understanding that the world has moved, that those emerging countries as well have some leverage with regards to the strategic relationship, and the United States of America will continue to think. With regards to Europe at the moment, Europe doesn't have a clear financial and also focused policy. That's the reason why Europe should take a stand. The continent of Africa has made it clear that it will not be embroiled with regards to the current strategic situations, as the African continent is looking for partners that share its own interests. We want to thank you for watching. If you are new here, we would encourage you to support our research. Smash the like button, share the video, and watch other informative content on our YouTube channel. We are looking forward to meeting you soon in our next episode. Have a good day. Bye-bye.